Good morning, good afternoon, and good evening, depending on where you are. Thank you for joining Mayer Brown's Global Financial Markets teleconference series. Today's call is entitled Commercial Financing Disclosures, Coming to a State Near You. My name is Jeff Taft, and I'm a partner in the firm's Financial Services Regulatory Enforcement Group in Washington, D.C. First, one or two housekeeping items. As regular listeners will know, this call is being recorded. We will email an audio link to all participants in case you wish to listen to the teleconference again or forward it to your colleagues. In addition, the recording will be available as a podcast. As we will not have a Q&A session, please send any questions regarding today's topic by email to gfm@mayerbrown.com, and we will respond promptly. This email address can also be found on your invitation. Joining me today are my Mayer Brown colleagues, Krista Cooley, Frank Doorley, and Dan Pearson. Krista is a partner in Mayer Brown's Washington, D.C. office and a member of the Financial Services Regulatory and Enforcement practice. Krista concentrates her practice on matters related to consumer financial services and products and advises clients on compliance with federal and state laws governing licensing, approvals, and practices of financial institutions, mortgage lenders, consumer finance companies, and more. Frank is an associate in Mayer Brown's Washington, D.C. office and a member of the Financial Services Regulatory and Enforcement Group. He handles a broad range of federal and state regulatory compliance matters, primarily for consumer finance product and service providers. Dan is an associate in Mayer Brown's Washington, D.C. office and also a member of the Financial Services Regulatory and Enforcement practice. Dan counsels clients on compliance with state and federal laws regulating consumer and commercial financial services. With that brief introduction, we can now begin today's discussion. Dan is going to lead us off with an overview. Frank will follow and discuss some considerations for sales-based financings. And finally, Krista will cover some of the key implementation issues facing our clients today.
Thanks, Jeff. So this trend started in 2018 with the enactment of California's Commercial Financing Disclosure Law, which was Senate Bill 1235. This was followed closely thereafter in 2020 by New York, which enacted a law that closely mirrored California's law with Senate Bill 5470 and Senate Bill 898. The California and New York laws both apply to a wide range of financing. Open and closed-end loans, whether secured or unsecured, but not mortgage. But in addition, merchant cash advances, factoring, finance leases, and an undefined category of quote-unquote other financing. Now, California's law applies to financing of $500,000 or less. New York's law applies more broadly to financings of $2.5 million or less. Both of these laws apply to quote-unquote providers of financing, which means the person that extends a specific offer of financing, which may not necessarily be the entity that provides the financing in all cases. Banks and certain other entities are exempt from both laws. Now, neither law has taken effect yet. Multiple versions of proposed regulations have been issued in the meantime, and financiers have been referring to these proposed rules to prepare draft disclosure forms and start the implementation process so they can get a head start on coming into compliance before the disclosure requirements take legal effect. The proposed rules do not include sample forms, but rather describe in detail how the disclosure forms should be formatted and populated. The proposed rules in California and New York get into the weeds on font size, font type, column width, and length of explanations, among other aspects. The disclosure formatting requirements vary by state, type of financing, and terms of financing. So after New York, about a year and a half passed during which no other states followed suit by enacting their own commercial financing disclosure laws. Then Utah and Virginia enacted their own laws back-to-back in March and April of this year. Some good news for the industry is that both of these laws are significantly narrower than the California and New York laws. Specifically, the Utah law, which is Senate Bill 183, applies generally to commercial open and closed-end loans, merchant cash advances, factoring, and certain leases of $1 million or less. However, the law contains some important exemptions not seen in the prior laws, including for captive financing, where a finance company is financing the purchase of equipment manufactured by its parent company, and for purchase money obligations, which should exempt basically all equipment financing transactions. Virginia's law, House Bill 1027, applies in the first place only to merchant cash advance transactions of $500,000 or less, which the legislation calls sales-based financing. So no loans or leases are captured under the Virginia law. One major twist is that both the Utah and Virginia laws require covered financiers to register with the state in addition to providing disclosures, as Frank will discuss shortly. So what types of information does a covered entity have to disclose under these laws, whether California, New York, Utah, or Virginia? The answer varies among the states, but depending on the specific law and type of financing, a financer may have to disclose the principal amount or credit limit, the finance charge as calculated under Federal Regulation Z, the annual percentage rate or APR, the term of financing, payment schedule, prepayment fees, or maybe other avoidable fees as in New York, and an itemization of amount financed in certain cases, which is a concept also borrowed from Reg Z. Looking at these laws, different financiers have had a lot of the same questions. First, when do these disclosures have to be provided? Well, generally it's at the time of a specific offer of financing, which basically means when an offer including the essential terms of the financing is made and is presumably binding on the financer if the recipient accepts the offer. It could mean that new disclosures are required if the terms of the financing change, and the proposed rules under California and New York describe exactly when that might happen. Another question we've heard is, if banks are exempt, what about bank partnership programs where a bank funds a contract solicited by a non-bank partner? And if the non-bank partner is subject to the law, which entity has to provide disclosures, particularly if the bank partner is exempt? It's not an easy question. The answer could vary among the laws, as the law's definitions of a provider and the wording of their exemptions differ. However, each of the four laws includes language that could reach certain non-bank companies soliciting offers for a bank. Another question we've heard is, what is the geographical footprint necessary for a transaction to trigger one of these laws? California makes it easy by letting a financer rely on the business address a recipient lists in its application for financing, or on a written representation that the recipient's business is principally managed from California. The Virginia law provides the same safe harbor language, but New York has not provided a similar safe harbor, and neither has Utah. Finally, companies are wondering what amounts and charges go into which buckets in the disclosure and itemization forms. Financiers are having to look closely at Reg Z to interpret the various disclosure requirements under these laws, even though this may not be a rule that has been relevant to their business previously. Last, before I turn it over to Frank, what's happening in the states other than California, New York, Utah, and Virginia? Right now, there are similar commercial financing disclosure bills pending in a number of states, including Missouri, where Senate Bill 963 would require disclosures by a person that consummates any of a wide range of commercial financing, including for online platforms partnering with a bank. There is no express dollar amount limit on the Missouri bill's applicability, although a limit could be imposed in rules if the bill is enacted. There is another pending bill in New Jersey. Assembly Bill 2150 and Senate Bill 819 would also require disclosures for an entity that makes or solicits a broad variety of commercial financing, but capped at transactions of $500,000. And there's pending New York legislation with Senate Bill 1061 that would require a company to obtain a license to make or solicit commercial financing in amounts of $500,000 or less, in addition to the already existing disclosure requirements in New York that we've already discussed. This New York bill, registration bill, has moved slowly, but it has seen some movement this month, although it's still in committee. If it's enacted, the bill would render void and uncollectible commercial financing products made by an unlicensed or unregistered person. And some similar legislation recently died in Connecticut, Maryland, Mississippi, and North Carolina. So with that, I'll turn it over to Frank to further weigh in on the Virginia law and the merchant cash advance space more broadly.
Thank you, Dan. I'm now going to talk about how the new commercial finance disclosure laws are written to capture some of the innovative and relatively newer forms of commercial finance, like sales-based financing, in addition to more traditional commercial loans and leases, as well as some of the challenges posed by extending these laws to sales-based financing. Now, Dan's already talked about the broad scope of the commercial financing disclosure laws enacted in California, New York, and Utah, and how those laws apply not only to more traditional forms of commercial finance, but also to sales-based financing, which is commonly referred to as merchant cash advances, or with the acronym MCAs. As Dan mentioned, Virginia's commercial financing disclosure statute is unique. Unlike California, New York, and Utah, the Virginia law specifically regulates merchant cash advances, but not any other form of commercial finance. Now, merchant cash advances are an innovative but growing form of alternative commercial finance. An MCA is not a loan or a credit product. It's instead the purchase of a business's future receivables at a discount. MCAs generally involve a provider purchasing the right to receive a percentage of a merchant's future, but not yet existing receivables in exchange for an upfront lump sum payment. Under most MCA agreements, the business agrees to deliver the receivables to the provider as they are generated in the ordinary course of the merchant's business. Now, one of the hallmarks of an MCA and what makes it distinct from a commercial loan is that an MCA has no fixed term or maturity date. Instead, the merchant is contractually obligated to deliver the receivables as they're generated in the ordinary course of the merchant's business. Because a merchant's business is subject to natural ebbs and flows, that means that the MCA provider might receive the receivables it has bought in 6 months. It could take 6 years, or the provider might not even receive them at all, since MCAs are non-recourse and generally provide that the merchant has no payment obligation in the event that the merchant goes out of business or files for bankruptcy in the ordinary course and is unable to generate enough receivables to deliver the full amount to the MCA provider. And again, because MCAs are not loans or credit products, they also do not bear interest like commercial loans do. The new Virginia commercial financing disclosure law follows in the footsteps of California, New York, and Utah by imposing specific disclosure obligations on sales-based financing or MCA providers. The MCA providers are required to make disclosures of the financing terms at the time that the provider offers an MCA to a merchant in Virginia. And these disclosures are generally similar to the disclosures required for sales-based financing providers under the other recent state laws, and include the total amount of the sales-based financing and the disbursement amounts after any deductions, the finance charge, the total repayment amount, which is the disbursement amount plus the finance charge, the estimated number of payments, and a description of all other potential fees and charges, among other disclosures. But unlike the California and New York laws, the Virginia legislation does not require that an MCA provider make any disclosure of an annual percentage rate or APR. Now, because the Virginia law does not define many of the terms used in the disclosure requirements, including the finance charge, and does not give merchant cash advance providers any instruction on how to calculate any of these disclosures, regulators are most likely going to need to issue guidance or regulations to implement those disclosure obligations. And the regulators are likely going to need to act fast as those disclosure obligations go into effect on July 1st of 2022. In November of 2022, the registration requirement will go into effect, whereafter merchant cash advance providers offering their products in Virginia will be required to register with the Virginia State Corporation Commission. On the topic of the registration requirement, we do suspect that it will become a trend among state commercial finance disclosure laws to include registration requirements in disclosure laws as an increasing number of states consider enacting similar laws. These registration requirements will generally provide state regulators with the authority to then examine providers for compliance with the disclosure requirements. Now, I mentioned briefly that under the Virginia law, merchant cash advance providers would not have to calculate and disclose an annual percentage rate, unlike in California and New York, for example. Now, the application of the APR disclosure requirements, particularly to sales-based financing or MCAs, presents a significant challenge for providers. It's relatively straightforward to make disclosures of an APR on a commercial loan, because on a commercial loan, a lender can generally know things like how much credit is extended, the interest rate, and other charges, and when the funds must be repaid under the terms of the loan. But the question is how an MCA provider is supposed to calculate an APR when the MCA provider does not know at the time it extends the financing things such as the amount of any periodic payment, how quickly the MCA provider will receive all of the bargain for receivables, or even whether the MCA provider is going to receive all of its bargain for receivables. The proposed implementing regulations to the California Commercial Finance Disclosure Law try to resolve this. Those proposed regulations allow MCA providers to make assumptions about a merchant's future monthly receivables in order to calculate the required disclosures. And under the California regulations, there are two methods that the MCA provider can use to make these assumptions. First, they can make assumptions based on a historical average of the merchant's sales that's based on data over at least 4, but no more than the prior 12 months. If the MCA provider uses this historical method and needs to make any additional estimates or assumptions, then it can do so long as those estimates are based on the best information that's reasonably available to the provider at the time that it makes the disclosures, and the provider clearly states that the disclosure is based on an estimate and what assumptions it relied on. And these are similar standards to how creditors making disclosures under the Federal Consumer Purpose Truth in Lending Act may use estimates when they're making the disclosures. The second method that providers can use under those California regulations is called the underwriting model. If the provider makes its assumptions using the underwriting model, then it has to make its calculations using the best information that's reasonably available to the provider. The catch is that once every 4 months, the provider must conduct an audit of all of its MCAs that were paid off during the previous 4-month period where the provider made disclosures based on its own internal estimates. And it must calculate an APR spread, which is the difference between the retrospective APR based on how the merchant actually paid back the MCA and the APR that was disclosed originally to the merchant. The provider then has to calculate a weighted average of its APR spread over the last 3 audits, last 5 audits, and last 7 audits. And if the APR spread is outside of certain tolerances, then the provider may only use the historical method for the next 24 months, unless the provider determines that using the historical method would have resulted in a greater weighted average. Now, the California regulations are a creative solution, and they do give MCA providers some flexibility and potentially provide a model for other state regulators to use in implementing commercial financing disclosure requirements on MCA providers. That said, it also does impose some significant record-keeping and ongoing compliance burdens on MCA providers. I'll now hand it over to Krista Cooley, who will talk about what commercial finance providers might be able to expect in the future.
Thank you, Frank. I'm going to spend the next few minutes discussing some of the key considerations and challenges that commercial lenders have faced as they go about implementing the new disclosure provisions and registration provisions that Dan and Frank have just laid out, based on what we are seeing as we help our clients navigate these new provisions. We'll also spend a minute or two summarizing what we expect to see in the future regarding these disclosure laws, some of which Dan and Frank have alluded to in their comments as well. So the first and most significant consideration from a practical perspective that we have encountered is how to put these disclosures into operation. We represent, as Jeff noted at the beginning of the call, a lot of consumer lenders and brokers, and those consumer lenders are somewhat conditioned to provide multiple disclosures to borrowers, both before and at the time consumer credit products are solicited and or made. Many brokers and providers of the commercial financing products that are subject to the new disclosure laws, however, do not have pre-existing obligations to provide these types of disclosures to potential borrowers. And thus the logistics of doing so has been a proven challenge, both in how to create these disclosures and also deliver the disclosure to the potential borrower. Consumer financing product providers first need to tackle the creation of the disclosures that are in compliance with the various laws that are now in place. And so that initial concern, and Dan referenced this a little bit in his comments, is that not all of these laws require that the same information be included in the disclosure. And the disclosure requirements differ depending on the types of commercial financing product, which could require multiple forms, either state-specific or product-specific. Several of the statutes are broad and lack detail regarding how the disclosures should be structured. But as Dan noted earlier, the proposed regulations in California and New York that we have seen so far are providing incredibly detailed instructions regarding things like, as Dan mentioned, font size, placement of information, and how to perform the calculations of the information that could be disclosed. And Frank noted some of the particular challenges with MCAs on those calculations. Now, these details are helpful, but absent a model form, each commercial financing provider needs to create these forms, ensure that they comply with the requirements for each commercial financing product that they offer in each one of these jurisdictions. And once those forms are created, the providers need to program their lending platforms to consistently ensure that as the forms are being generated and completed, they are in compliance with each of the financing transaction requirements. And again, on the consumer lending side, we know that several document providers over the years have cropped up to help accomplish these tasks as a service to consumer finance providers. And that could certainly happen on the commercial financing disclosure side as this disclosure obligation gains more traction. So once you've created the form, the commercial financing disclosure needs to be maintained and amended in the event that there are any changes to these laws and the implementing regulations in the future. And as Dan noted, we're already seeing that New York is considering changes. And so it's an area where those that are subject to these disclosure requirements will need to follow and potentially tweak going forward. Another challenge associated with creating compliant forms is the timing between the issuance of the guidelines to do so and the effective date of the laws to which the providers need to begin to comply. So in California and New York, we've seen multiple versions of the regulations and extensions of time so that the regulators can finalize the guidelines and give providers the needed time to build out these forms. Frank gave a good example in Virginia of how quickly the timing between the law's passage and the law's effective date for provision of disclosures, and just how little time the regulators and the providers of the disclosure forms may have in order to accomplish these tasks. Now, we have seen the regulators, as Frank and I mentioned, provide extensions and push out these effective dates to provide that time. But it is definitely something that we're not seeing the state legislators think through as they're passing and considering additional amendments to these laws. Another challenge associated with timing is how the commercial financing providers will actually deliver the disclosures to their recipients. As Dan noted earlier, the statutes require the providers to disclose all of the information required by each law at the time the specific commercial financing offer is made, and must obtain a signature before the commercial financing transaction is consummated. Redisclosures could be required if those disclosed terms change. So many in the commercial sales and financing industry have had to think through how to implement such disclosures into their sales and financing processes, particularly those who rely on dealers and third parties as part of this process, which can complicate that delivery. Another complication is if the state-specific forms are needed because the disclosure requirements are different, providers have to ensure that the right form under the right statute in the right state is being provided to the applicant. And ensuring that these disclosures are provided to recipients in compliance with the various requirements takes some lead time, which, like the creation of the forms themselves, can be complicated by the uncertainty of effective dates or any type of short time period between final regulations that lay out how this process needs to work to be in compliance and the buildup of such disclosure provisions. One other point is that it is incredibly important through that build-out process to test compliance of both the format of the disclosure and the delivery process over time to ensure that compliance is actually happening. So I want to shift away from the disclosures for a minute. As Frank noted earlier, the two most recently enacted laws in this space in Utah and Virginia have also included a requirement that the commercial financing providers register with state regulators, both initially upon the effective date of the statute or when the commercial financing activities begin in that jurisdiction, and then annually thereafter with associated annual fees. And while the Virginia law does not include details regarding how the regulators are going to implement that registration requirement, the Utah statute does require that the registration applicant be registered with the Nationwide Multi-State Lending System, otherwise known as NMLS. And so based on that reference, it appears likely that the registration application, as well as the maintenance and renewal of the registration, will be facilitated through that NMLS system. Now, for commercial financing providers that are already established on that system, which is the system of record for non-bank financial services licensing and registration for a multitude of licenses across all 50 states, using that system for Utah's registration requirement could create some efficiency. But if you're a commercial financing provider who has not previously been required to establish an NMLS record for any other licenses or registrations that you need to hold, using the NMLS could create challenges, particularly because in order to use the NMLS, an entity must first establish a record on the system, which requires completion of a form that includes extensive identifying information regarding both the company and its control persons. And the system was really designed to create efficiency for entities who need to obtain multiple licenses or registrations, but can prove to be onerous and somewhat over-inclusive for those entities that need to access the system to obtain only one or a few registrations, which may be the case for some of these commercial financing disclosure and registration laws that we're seeing come on the books. So I know we've taken up a lot of time. I'll just briefly end my comments today with a focus on a few of the trends that we anticipate in this space going forward. So as Dan mentioned earlier, we're already seeing that there is similar legislation being proposed in multiple other jurisdictions. We still have active legislation in 2 states. Dan noted, I think, 4 states in which legislation has just recently died, either in committee or by not being passed. Any of those provisions could be revived, and we expect that other jurisdictions not on that list may decide to introduce and pass similar legislation as this disclosure obligation trend takes hold. That new legislation could include the registration and licensing in addition to the disclosure requirements like those most recent statutes in Utah and Virginia. We expect that any new proposals will likely include similar exclusions. We talked a little bit about exclusions for financial institutions and their regulated subsidiaries. We've also seen exclusions for de minimis transactions, so those commercial financing providers that do less than 5 financings in 1 year. We've also seen exclusions that include floor plan financing. At least one of these laws provides an exception for captive financing companies, those could be exceptions that we may see or that the industry may want to lobby for in connection with legislation that comes down the pike. I think the one big trend that we would really like to see, both as the industry and also in the trade associations who have been actively engaged in following these laws, is the hope that any new legislation parallels as much as possible the existing laws that are now on the books in the jurisdictions we've talked about today, which would create some uniformity in disclosures and help facilitate the implementation of the new provisions and ease some of those challenges that I talked about in detail. And with that, I will turn it over to Jeff for our concluding remarks.
Thank you, Krista, and thank you for our audience for listening today. As you can tell, this is a rapidly evolving area that presents significant legal and operational challenges for many clients. I would also note that the complexity and lack of uniformity amongst these state laws has the potential to disadvantage non-bank providers of commercial financing, especially as more states adopt these laws. This is certainly something to monitor, as Krista said. Before we break, a few reminders. You'll receive an email with a link to the recording of today's call, as well as some client alerts related to these developments. The recordings will also be available as a podcast. Lastly, as mentioned before, if you have any questions related to today's content, please email them to gfm@mayorbrown.com. Thank you again for your participation. You may now all disconnect.